Are you looking for a program to help you build a better path to prosperity? Well, you've come to the right show. The Master of Money program is built for you, the individual who needs a friend in the financial services industry. Tonight, we're going to continue our program from last week talking about financial planning, and we're going to give you 10 keys people often forget as they prepare a financial plan. So join us tonight for this edition of the Master of Money. Tonight's Master of Money program is sponsored by Harvest Investment Services, where they harvest gains and minimize losses, and by Superstock Investor, empowering individual investors with professional research. Tonight's special guest is Doug Roberts, principal of Channel Capital Research Institute and the author of Follow the Fed. This Master of Money was produced Tuesday, February 24th, 2015. Good evening, everyone. I'm Steve Beeman, and welcome to the Master of Money. I'm very pleased that you've chosen to join us tonight for this program dedicated to helping you build a better path to prosperity for you and your family. You know, the things we talk about here in the Master of Money are the things many people just wish they were taught, but never were. They don't cover this type of information in the schools. Maybe they should, but they don't. And so we're here at the Master of Money to fill that gap. So thanks for joining us. Tonight's program, we're going to continue on last week's Building a Financial Plan theme. And where last week we talked about why people don't do it, this week we're going to cover 10 key areas of the plan that people should include. Many of them are common sense. I'm sure you already thought about it, but maybe one or two of the ideas is something that you haven't thought about yet, and that's what tonight's program is dedicated to. Now again, last week we started talking about building a financial plan, and we talked about reasons people don't do that. We talked first about apathy and the feeling of hopelessness some people have as they look forward to building a nest egg so huge that they never think they can get there. But we did share some ideas with you on how you can shrink down that future nest egg requirement by using some very common sense measures that can help you get some hope and begin to get over the apathy and actually drive toward that success. We also exploded this myth people hold in their head about I'm too old or too young. No one is too old or too young to build a financial plan that serves them, and we wanted to dispel that thought right at the outset. And in our super stock segment, we talked about the continuing volatility that we see in the markets, but we also talked with you about how to build a sell discipline. Now, I hope you took that to heart. It's interesting, as I go back to Chicago Investment Analytics way back in the 1990s, our firm pioneered some of the research into how to sell a stock. It's interesting, as you look to Wall Street research, the vast majority of it, I forget the exact number, but we're talking 80% or more. The vast majority is dedicated when to buy a stock. Very little research is done on when to sell a stock. And the insights Jeff shared with us last week can help you build that sell discipline that's so important. So we hope you enjoyed it. And of course, if you have any questions, feel free to write us at questions@safefinancial.org, and we'll get to those right away. We love answering viewer questions, and so we welcome you to write us. Now, last week we did get a question that I thought was very appropriate to answer for you, because I've talked in the past about the seminar series that go on around the country, whether it's real estate flipping or option writing or whatever that seminar may be. We want to make you aware of what's being taught. Just maybe we can save you some money. One of our viewers wrote in and said, Steve, I was invited to attend a seminar that promised to show a way to make 2 to 3% per month on my investments. Should I spend the money to go? Well, here was my answer to this gentleman. First, thanks for writing us about it. Secondly, what they're referring to in those seminars is what's called a covered call writing strategy most often. And so what they're suggesting you do is that for stocks that you may own, you sell calls against them. This is a fairly common procedure. It's something that we will frequently recommend people do if they hold stock positions that they don't mind selling out of and they're very comfortable with it staying at the same price. Let's take this example. You own a stock that's at $40 and you're comfortable selling the stock at $44. You've gotten a nice gain and you believe it's stable at that $40 level. Okay, In that scenario, by selling a call against it, in other words, selling the right for someone to take that stock away from you at, say, $44, you've accomplished your goal. So you've also, in addition to that gain, you've been paid a premium for giving them the right to take the stock from you. Sounds pretty good. And indeed, in the right circumstance, it can be good. But here's the dilemma that they don't tell you in these very expensive seminars. Selling covered calls reverses much of the risk parameters of stocks in general. Let me be specific. We've talked in the past about the risk of stocks. When you buy a stock, and again, let's say we buy that $40 stock, you have theoretically unlimited upside. It could go up as much as it can, but you have limited downside in that you can lose 100%. So you have limited downside, unlimited upside. Well, when you sell a call on a stock, you've changed that dynamic where now you have a very limited upside, but you still retain the 100% downside. And this is where investors get caught in a trap. If you're not confident with the stocks you own underlying the calls, you could see those stocks depreciate in price far greater than the premium that you're receiving, and therefore you lose money in the underlying stock. So writing covered calls isn't always a panacea. It's not the end-all be-all that can make you all this money every month. It's a viable strategy. You should have it in your quiver of arrows. But don't be suckered into paying $2,000 to learn how to write a covered call against stocks that may go up or down. It can be a very high risk game. So what you want to do is be cautious that when you use a covered call strategy, you first don't mind getting out of the stock because you're going to pre-agree to give that stock up at a certain price. But you also don't believe there's risk in that stock going down more than the price of the premium you're paid. Now, we welcome you to write us always at questions@safefinancial.org, and we'll try to answer those questions for you. But on that one, we hope that we can save people a couple of $1,000s in a seminar that might just mislead them just a tad. Now, in the geopolitical world, far and away the most important thing last week was the President of the United States who approached Congress for authorization to begin using military assets against this problem with ISIS in the Middle East. Now, you and I both know these people are hideous. They kill people with the worst possible forms. They hang them, they crucify them, they chop their heads off, they burn them. These people have a serious problem. And you can look politically and say we must do something. But we're not here on the Master of Money to talk politics. We're here to talk about economics. So let me share the economic ramifications with you. Two big things. First of all, we've seen our deficits come from about 1.2 trillion down to the current 500 billion over the last several years. A lot of that has come out of the military budget. Well, by getting this authorization, the military will require additional budgets to go fight a hot war, and that's going to cause those deficits certainly not to continue down, if not maybe rise a bit. Secondly, though, the imposition of the American military might in the Mideast could serve to negate some of the instability that we're seeing in southern Europe and in the Middle East, specifically with Israel. What that will do is serve the global markets with some confidence, and that could be a little bit of a boost for stocks, and especially for those invested in Middle Eastern type relationships, oil companies and the like, defense industries. So economically, we don't think this is going to be a big deal, but it could ultimately, if it's done right, lead to some additional stability in the Mideast. That's a good thing. Now, on another note, and I'm going to touch what could be a hotbed of controversy when I say this, but I want to talk about it to the right, who's going to say I'm crazy, and to the left, who's going to say I'm crazy. There was a report issued by the Agency for the Central American and Caribbean Islands and countries, and it talked about the growing income disparity. There's that phrase. We hear it in the United States and everywhere these days. Seems to be pretty popular. But they were talking about the income disparity in the Caribbean and in the Central American countries. The problem they have is very similar to what's going on in the United States. We have seen in the U.S. wealth in our country become extremely concentrated. You can't argue with these numbers. They're the facts. It used to be that, say, 10% of America owned 90% of the assets, the wealth. Now that number is more like 1/10 of 1% owns all the assets. And what's causing that is largely the stock market boom that we've had. When the Federal Reserve keeps interest rates at zero like they've done, it forces stock prices up, and that benefits the people who own stocks, which tend to be the wealthier people. That pushes the distribution of assets further and further to one end. That's going on in the Central American countries as well. But the second thing that's happening there, just like it is here, is the growth in technology. We are rapidly replacing what used to be middle-class jobs with technology. They're seeing it as well. And as that happens, this barbell economy continues to grow. Now, we're not sure where this all ends. Technology is a double-edged sword. But right now, we are seeing income disparities grow. Now, where it gets to be contentious is half the people are going to say government is the cause of this disparity. The other half are going to say government is the solution to the disparity. Well, maybe on some future Master of Money we'll tackle that particular fight. But right now, let me say this. The income disparity we're seeing in the United States and around the world that seems to be growing is a function of changes to technology, changes to economies, globalization, and again, a zero interest rate policy on the part of the Fed. Now, I watched an interesting show on the Federal Reserve. In fact, I'm going to go ahead and put this up on the screen behind me. But there's a show, if you have some spare time, go onto YouTube and watch this little program. It's not anti-Fed, it's not pro-Fed. It's a factual look at how the Fed works and the problems that it has caused by trying to manage our money supply. I think it's worth seeing, and it ties into our guest tonight, Doug Roberts from Channel Capital Research Institute, who's written a book called Follow the Fed. So all of this ties together, but that Central American report, I think, highlighted some of the things geopolitically that we're seeing around the world. Economically, the biggest thing that I wanted to talk to you about, last week I spoke about retail sales. And I talked to you about how retail sales are dropping, and they were just really seriously dropped in late December and January, and that was a concern. Well, just this last week, new housing sales dropped as well. That's another indicator that this recovery you and I keep hoping for isn't really there. The fact of the matter is confidence fluctuates up and down radically based on instability in the economy, instability in the geopolitical world. Something as small as the weather in the East Coast can really affect this economy now. And we saw home sales really come out with some bad numbers. So that was something that we want to watch. It didn't get reflected in the markets so much because of a couple of things. First, again, with zero interest rates, where else do you go? The market's got that support system. Secondly, there are still some indicators that are good. Some of the leading production indicators look okay. So there's this bipolar economy we've talked about. It can't decide if it wants to be good or bad. But either way you look at it, we want to be very sensitive to those lagging indicators like home sales to make sure that we don't get caught in a trap. We've talked about risk management on your portfolio, and now is increasingly a good time to do that. Most important economic thing I think I can relate also is that Janet Yellen, the chairwoman of the Federal Reserve, will be speaking this week to the Federal Board of Governors. It's called the Humphrey Hawkins hearings, and it's a requirement that she speak to the governors and to the Congress. So she'll be in Congress testifying before them, and it will be very interesting to see what Chairwoman Yellen says about the zero interest rate policy. Are they going to try to raise those rates up? That would be good for savers, be bad for the markets. But we'll see how they manage that. And certainly stay tuned to the Master Money for all of the details that we can possibly give you about that. Moving into the financial world, there was a very important ruling from the Obama administration, or I'll say a proposal for a ruling, where they've gone to the Department of Labor and asked for a major transition in financial services. Right now, brokers of financial products have a responsibility to sell you only investments that are suitable for you. Meaning, by evaluating your age, your income, your assets, they can only sell you an investment that meets your constraints. Well, the Department of Labor under the Obama administration wants to take that to the next level and make those brokers fiduciaries over that relationship. This is a major thing, and let me try to explain it. If I'm a broker for a major firm, say I'm from Merrill Lynch, right now I can go into a client and I can sell you Merrill Lynch product that meets the standard of appropriate for you. However, if I'm now a fiduciary, it may just be that the products offered by Merrill Lynch aren't the best thing for you, and I have to sell outside of my firm. Well, why in the world would Merrill Lynch put up the money for a brokerage relationship where they don't get anything back on it? They won't. Wall Street's going to fight this tooth and nail, and the unintended consequence, you and I could agree or disagree that they should be fiduciaries, but the unintended consequence of this will be that small investors no longer will be able to get any advice from anyone. We already see that in the investment advisory arena. Private investment advisors typically have a minimum on their accounts, say $500,000, because below that, it's just not financially smart for them to take the account. If they impose this fiduciary standard, you'll see that come down further, and brokers will not be wanting to work with small investors. Now, that makes the Society for Financial Education all the more important because we want to work with you and we want to walk you down this path. But you will see a raising of these minimum standards from the investment advisory business because as these regulations come out, changes in how people do business is important. And again, Wall Street's going to fight this tooth and nail in the courts and everywhere else. We'll have to see where it comes down. My guess is the regulations will be approved and that you'll have this fiduciary standard placed on brokers, which is going to make them really gun shy to make recommendations. But we'll have to see where it goes. Now tonight, as I said, we're continuing in our path to prosperity, talking about financial planning. Last week, we talked about the reasons people don't do financial planning. Well, tonight, we're going to talk about 10 key components of any financial plan that should be in place. And I hope you'll stick around for that because even though some of it's common sense, you may find a couple of ideas you hadn't thought about yet, and that's what we're trying to do here is generate some new ideas for you. So stick around and we'll be right back with the second half of The Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Hello and welcome back to the program. We continue on our mission here to help you build a better path to prosperity, and we want to give you all the information you need to do that. Often, as we've discussed, the core of that path is the plan that you make. And again, last week we talked about why you don't do it. This week, I want to talk about what are the 10 things you definitely need to have in your plan that, yes, some of them are common sense, but oftentimes they're forgotten by people. So I want to go through these one at a time, and then afterwards, I'm very pleased to have Doug Roberts join us tonight. His segment will be fascinating for you, I hope. He's with Channel Capital Research Institute, and so we'll talk about him in a minute, but I'm excited to get him on the program tonight. Well, let's talk about 10 things that you need to consider when you're building your financial plan. The first thing on this list is the most obvious, and it's called income requirements. You need to know about how much money you're going to need to pull off a satisfactory retirement. But I want to share a thought with you that's a little bit out of the box on that. I've talked to people all the time, and they say that in their financial planning systems, they're looking at saving 80% of their last year's income or something like that. Well, I've been in a position where I was retired, and I will share with you that the fact of the matter is I spent more money in retirement than I did when I was working. Simple reason, I had more time. There's this weird inverse relationship in life, and I've talked to my kids about it, but you have time and you have money, and they are most often not balanced. You have a lot of time and no money, or you have a lot of money and no time. The goal of retirement is to match your time and your money. And you may find that it costs you a little bit more in retirement than it did while you were working, simply because you have more time. So as you look at your income needs, as you plan out for your retirement, you might think about plussing up your income requirements just a tad. Second thing, and again, I think most people do this, but I want to bring up some deeper ideas on it, and that's planning for medical care. We all know that as we hit 65, we're going to get Medicare, and we're going to go out and get a supplemental plan. But one of the things that I want to talk to you about is to go a little deeper. As hard as it may be, go into your family history of neurological disease, of heart disease, of cancer type things, and try to get a better evaluation of where you stand. The fact of the matter is we're all living longer now. And what you don't want to have happen is you get one of these hereditary diseases and find out 10 years after retirement that you never thought about whether you'd get it. We need to look back at our family's past, look at our broad medical records, and make sure that we've planned enough medical coverage in there for what is the likely outcome for us. That ties into the third thing, which is, of course, your spouse. Don't negate planning for your spouse and their medical condition. Again, we're living a lot longer now. It's conceivable people start living to 90, 100 years old. We don't want to be in a position in retirement where we all have to work as greeters at Walmart. There aren't that many stores. So you need to plan adequately to cover your income needs and your medical needs. And third, or fourth, I should say, talk about your kids. There are a couple of key components here. First of all, we all know we want our kids to have it better than we had, whether that's through college that we didn't have or through life experience, whatever. But one of the things to do early in a financial plan is think through where your kids are situated. It may just be that you've devoted everything you have to your children and they want to give back to you. Well, if that's true, talk with them about your plans. Don't be shy about this. Share with them where you're headed. It helps for them to know so they can plan. The bottom line, this is a comprehensive plan. So whether you're talking about your income needs, your medical needs, your spousal needs, or your children's needs, all of that should be in there. In addition to that, digital assets should be in there. And this is coming up more and more, obviously, with the integration of social media, of electronic banking, electronic everything. Make sure that in your plan you've laid out where all of your digital assets are, your account passwords and usernames. This is part of a will structure too, and I'm sure your attorneys will talk with you about it. But build it in as part of your financial plan to have a digital vault where you can store that. And that leads actually to another area, and I'll jump ahead a little bit. But what I had as number 10 on my list was what they call asset consolidation. Tying into this idea of your digital life, there are now systems that allow you to build a digital vault of all of your planning documents, your wills, your trusts, your insurance programs, and it can all be stored up in the web. Now, I know some of you are saying, well, is it safe enough to do that? And the answer is yes. The encryption technology is powerful enough that you can store your documents and those information pieces on the web, which helps you when you travel so you can get access to them anytime. It helps you in planning so you can bring together your accountant, your attorney, your financial advisor, and all have access to this. Information is key. And these digital vaults give you the ability to store all of your information up there electronically so your family and advisors can all get access to it. That ties then to my seventh area, which is trust. And we talk about this with kids often, but in general, make sure you talk to your advisor and your attorneys about trusts. There are all kinds of trusts that exist out there. In fact, I was just made aware of something called a spendthrift trust that's out of Texas, but I think it's acceptable in all the states, where you give up control of your assets kind of to a trustee, and they give you back money out of it as you need it. It protects your assets from creditors largely, and so there are some benefits to those types of things. Creditors passing money down in what's called a second generation trust, where maybe you have some assets and you don't want to be taxed on it, so rather than giving it to your children, you give it to your grandchildren. Well, there's no estate tax there. There are a lot of things you can do with trusts. So make sure you familiarize yourself and ask your advisors, ask your accountant, ask your attorney, ask your financial advisor, where a trust may just help you transfer assets without probate on a much cleaner, smoother basis. Then the other thing to consider is tax considerations of Social Security. One of the often misunderstood things from people is knowing when to take Social Security. You can get it at 62, and it's very tempting to take it. But if you wait until 70, you get an additional payout from Social Security. And when I talk to people, on average, they say, well, it's probably 30% more, 40%. No, you get a full 70% higher payment if you wait until 70. Now, the fact of the matter is we are living a lot longer. And I'm 53. People that are my age or less should plan on probably working to 70. It's still productive life. There's no reason in the world not to do it. It helps us put more money aside. You get better Social Security benefits, and you've still got 20 years on the back end to do whatever the heck you want with your time, assuming that you have the money. So this idea of a 70-year-old retirement, you should seriously think about, not just for yourself, but also in drawing out those benefits. And then again, as you build to this, talk to your advisor about every conceivable form of tax-advantaged investment you can. If you just sold a company and you've got a big chunk of cash, consider annuities. They're tax-deferred. Even if the rates aren't that great, they're tax-free on the way up, and that pluses up your return considerably. Make sure that you've looked into your 401k matching program so that you are getting that match from your employer. If ever there was free money, that's it, and you ought to be taking it. KIOs, IRAs, all kinds of vehicles that allow you to accumulate money tax deferred. That's a huge benefit to you if you're in the upper incomes. You're talking about a 30 or 40% increase to your return every year. That's not bad. So as you begin to build this plan, think about tax issues, think about trust, think about the stakeholders. And the final thing is, don't forget philanthropy. This is actually really interesting. As I talk to people more and more, the older they get, the more they get concerned with how their estate will look from a philanthropic standpoint. A university that was good to them, a medical institute that was good to them, somewhere that they say they want to make a statement with their assets. Well, that's an important consideration for you, so don't hesitate to talk to your financial planner as well about the deeper needs you have, the desire to make a real difference in someone else's life. So those are 10 things that you should definitely think about: your income, your spouse, your kids, your medical needs, your philanthropic considerations, your digital passwords, digital assets, your Social Security considerations, trust, tax-deferred or tax-advantaged investments, and consolidation of your assets. If you're not doing one of those things, please do. It's part of building a plan, and your advisor, assuming that they're good at building comprehensive plans, can help you do that so you don't have any T's that aren't crossed. This is a serious thing for people. We need to start planning. The fact of the matter is, we've got, what is the number? 10,000 people a day roll into retirement. Of that 10,000, probably 9,500 aren't prepared for it. Don't you be caught in that group. You be the one with the comprehensive plan. Well, now I want to introduce a new contributor to the Master of Money, Mr. Doug Roberts. Doug is a principal at Channel Capital Research Institute. I've known him for a long time. He became very well known for his book, Follow the Fed, where Doug studied the behavior of the Federal Reserve and the response of the markets to it. This is a really important book. If you look up on the screen, we're going to put Doug's contact information. If you'd like to get his newsletter sent to you or get access to the book, Follow the Fed, reach out and talk to Doug. He's a good guy. He'll love talking to you, and his insights are invaluable, just like Jeff's and Tim's and the other people that we bring you here on the Master Money. Now, he and I recorded a session earlier today, so we're going to go ahead and play that for you now. So, ladies and gentlemen, welcome Doug Roberts to the Master of Money.
Thanks, Steve. I want to welcome you all to Masters of Money and welcome you to the monthly commentary of Channel Capital Research Institute. Our subject today is going to be the economic cross-currents we're experiencing and the muted rally scenario that we're seeing. When I first discussed the prospects for 2015 over the last several months, I mentioned several potential scenarios for the financial and equity markets. One would be that we would shoot up like a rocket ship and that kind of brush off, in essence, this range-bound motion. The other thing would be a deterioration, and the other idea would be some type of a muted rally with lots of volatility. I think the muted rally scenario for 2015, based on recent events, is becoming much more likely. It's going to probably be extremely limited with only single-digit returns and large amounts of volatility. Now let's take a look at the factors that are impacting our forecast, with many of them acting as cross-currents to each other. These factors, of course, are continually changing, with the result being substantial volatility. First of all, what we're seeing is our indicators are showing there's adequate liquidity in the financial markets for a continuation of this equity rally. The market is reaching new highs and probably will continue to do so over an extended period of time. It's just the actual progress that it makes will be somewhat limited. And really what's fueling this is the safe haven status of the U.S. financial markets has really attracted enough capital from quantitative easing by the other global central banks to really offset the Fed's discontinuation of QE here. And also the prospect of conventional tightening. So really that's one of the reasons why you're seeing, despite the possibility of a Fed tightening occurring, you're starting to see bond rates still stubbornly stay down. And that's because really it's being limited by the QE from overseas. If you look at overseas bonds with all the risk, and basically their central banks are forced a certain level that's lower than basically U.S. Treasuries, something has to adjust, and usually it's the yield on U.S. Treasuries. Now, this could change quite dramatically if the Federal Reserve prematurely tightens monetary policy here too extensively.
I want to thank Doug for contributing that segment to the show. I hope you enjoyed it. It certainly is sophisticated stuff. This guy knows his details. So don't forget to order the book, Follow the Fed, and visit Doug at channelcapitalresearch.com. Now, we'll be back next week, and we're going to continue on the financial planning theme. We're going to come up with some deeper ideas to dig a little more into it, maybe how to get money out of your plan at the end. But we want to continue that. I may have a guest. If not, we're going to have another segment with our super stock friends. We find their contributions to be invaluable. So we hope you'll join us for that once again. And then next week on Tuesday, we look forward to seeing you for another edition of the Master of Money.